This meeting is being recorded.
Hey, everybody. We're bringing Mayhem on today. Buddy of mine, we've been talking for a long time about markets and what's been going on in the markets. He has very interesting views on the markets. Well, I got to watch him build a great following on Twitter over the years and just building up to constantly posting great information, constantly posting things that, make you think, constantly updates about things that a lot of people aren't talking about. So I wanted to get him on here to kind of have some conversations about the markets and what we're thinking in 2022. So how are you today?
Hey, Jason, thanks for having me on. I'm doing pretty good, my friend. How are you?
Oh, good. No complaints. Weather here is up and down in Ohio, but that's Ohio. I don't know why people live here, and we're kind of all we're kind of all masochists in this area. Loving this weather. Yesterday it was like 45 and sunny, and then it started raining, and then the roads iced over, and then this morning everything's snowy. So we're normal Ohio weather.
Sounds cold.
Yeah, very, very, very. So how's everything in your area?
Everything's good. Not quite as cold, but it's cold. And, it's really kind of got me thinking about some of the opportunities in the commodity space. I've been thinking about natural gas because of some of the cold snaps that are going on. So that's an area where, from a technical basis and perhaps even a fundamental and weather-driven basis, there might be some opportunities. So I've got a small swing position on in natural gas that I started last week. And I've really been looking at things this year through, the lens that I started to take in the last quarter of last year. And that is that, sometimes with the amount of volatility we have, depending on what one is trading, of course, smaller position sizes and in some cases smaller time frames have suited me. And the reason I mention that is that, last year, it was a little bit more of a stable market regime. It was mostly just climbing and climbing with 3 to 5% pullbacks along the way. Things are starting to feel a little bit different the way they're trading now. Of course, I could be completely wrong and misreading the tea leaves here, but it does seem like on a macro and technical basis that there's some reasons to look at the sort of leptokurtosis of fat tail risk distribution with a little bit more attention than we did in 2021, because as we've seen with the Fed minutes and as we saw today as well on Monday, January 10th, we've had these days where sort of a powerful amount of momentum from one side or the other really shifts the market dynamics pretty rapidly. And there's so much leverage in this market from options, from margin, from just more participation and more people using leverage in that participation. So it's a market that really can turn on a dime. And I think that the market action today was pretty fascinating in that sense, is that we started off with a sort of like end of the world type of sell-off in tech, and now we have this violent reversal where the NASDAQ actually managed to close marginally higher. So definitely an interesting trading environment. It seems like this first, couple weeks in January and the last couple weeks of 2021 are sort of a prelude perhaps for what's to come.
Nice. Great overview. And let's talk through the first thing you said was in the commodities market. So that's one thing that me, that's where a lot of my focus is. But I think anybody who's a good trader can move from commodities to equities to bonds to currencies, whatever we want to trade. So looking at the commodities market, though, you're absolutely right. Like, all I see right now is opportunity. I mean, part of me is like, I'm almost sitting here like wanting to hit too many things and buy too many things right now, because there's so many things that are constantly making these reversal bottoms right now. Like you said, even today, looking at last week, we started to see some, and wheat kind of put on a major reversal on Friday, and then this week opens up and wheat selling off, and then it ends up closing up. The NASDAQ, even though most people would think that, hey, the NASDAQ was going to take a hit, especially with yields rising, but the NASDAQ ends up closing the day up, so you have to take note of that too. These markets could be very quick, considering that we're kind of getting into that point where liquidity might start tightening up at some point this year. So I absolutely agree with you that we kind of have to start looking at different timelines. I always liked, there's a guy, John Netto, he's in the New Market Wizards book, and he has a book where he talks about being the protein trader, meaning that protein meaning you can easily shift between styles, time frames, whatever you need to do to continue to do this well, you can easily do that. And I think that's kind of a great lesson for this year is we're going to have to be a little bit more tactical on things. Over the last couple of years, I've been as guys in my group especially know this, that I've been extremely long in my trend following portfolios. My trend following has been the most signals I've been getting. I've been very long for long-term swings, position trades, and so on. Whereas that it wasn't my style a couple of years ago. So as these things kind of shift and change, I think we'll be jumping from style to style to style, especially this year. I think the beginning of this year, I think we could still see some massive trends playing out. But I think at some point we're going to be kind of moving into the zone that you're thinking of.
Yeah, it really does. It feels like, it's a trader's market. It feels like it's a stock picker's market to some extent, where in this sort of late cycle environment, as you touched on, liquidity could become more constrained this year. I think the minutes last week were very revealing. I know that there's a lot of different takes on this out there in the financial world, but my view on it, and I'm interested to hear yours as well, is that, the Fed really wasn't clear during the December meeting press release or during Powell's subsequent conference that not only had they discussed balance sheet runoff, but that they had actually planned it with consensus to happen after the first rate hike. And I think when the market received that news and began to process it, it was pretty bearish, because this is really a liquidity-driven bull market. And what the Fed is saying is, not only are we going to shut off the QE spigot that's been filling the liquidity pool, but we're actually going to start draining the pool in two ways, with rising rates more rapidly than perhaps some expected, and also with this quantitative tightening, where they're actually selling assets off their balance sheet and draining liquidity out of the financial system. And just like when that liquidity, that wave of central bank liquidity came in during early 2020 in response to the COVID crisis and bid all assets up, when they start pulling that liquidity out, it can have the opposite effect, particularly on longer duration, higher beta names that are negatively correlated with rates. So it's something that I have a pretty close eye on as a potential theme. It's sort of a continuation of what we saw in 2021 after it became more clear that the Fed was going to probably get involved with tapering and then tightening, and then as the narrative went on, we find out eventually quantitative tightening as well. So that's a theme that's important. I think on the other side of it, we also have some issues to consider, because the Fed is really without the requisite levers to pull to stop some of the supply chain driven inflation. I mean, they can slow down the economy, by raising the cost of doing business and deflating the prices of assets, but ultimately they can't, re-lubricate the engine in the economy by doing that. In fact, it might, for some components of the supply chain, increase their cost of doing business because the cost of funding their debt goes up, and therefore they have to pass that cost on. So I'm not sure that, besides really the jawboning and trying to scare speculators out of positions that might cause some pass-through inflation and destroying some demand side, that they really have the tools to resolve this issue. And then on the fiscal side, we heard this week, Nancy Pelosi is talking about, well, we should probably pass more COVID aid. And it's like, it seems like the legislature has really lost sight of they're the ones that are pushing the demand-driven inflation to a fairly large extent. The Fed reducing the cost of buying a house has played a role too, but giving money to consumers and who are set to buy more and even in some cases hoard things they think are going up in price can kind of create that feedback loop. So it's very interesting how both parties are telling the Fed, let's try to curve this inflation the best we can, but then they're going ahead and putting forth the kind of spending that actually drives the very same. So it almost puts the Fed in a box a little bit.
Yeah, no, that is well said, and that's it's spot on, because it's This is always the toughest part of trading that I've dealt with over the years. And one thing that I can say is that it's easy to get ahead of ourselves, meaning like it's easy to go, okay, well, we both see this, and we both see these in pretty similar ways. Risk-on sectors are not going to enjoy any of what we're talking about, but right now what I find that a lot of traders get in trouble with, and even myself in the past and everybody I've ever known, is that we start to get into this, okay, we can see this coming, therefore now every position we put on, we're thinking of this thing in the future. So there's two different sides of it. One being, as traders, we kind of have to be, the market is where it's at. Financials and high beta sectors, energy and so on, are looking great. The defensive sectors, healthcare, consumer staples, and all of these are still underperforming over a year time frame. They're majorly underperforming everything else. So we're kind of still seeing that, okay, well, we need to still be in this trade. We still see this kind of reflationary trade moving, and this is something that we're going to continue to kind of focus on. But in the back of our minds, keep in mind that this is going to change most likely at some point. Will we ever know the exact point? Will we know the day? Will we know the month? Most likely not. We'll look at our technicals to kind of understand those things. But I do see that there's that angle of it, which is the one thing that I'm actually I'll be bringing Jim Leitner on at some point to talk about this with, because he was the person who made me start to study this whole thing on regimes and not getting too ahead of ourselves. He was the first person I ever heard say, hey, you know, you can have these regime models, you could be just like Dalio and all these things, but if you start looking too forward in regimes and start positioning a specific way before these changes happen, you're going to start hammering your own returns. So while, you know, we agree about this, we also have to keep in mind that and you obviously know this as well, because you're talking about these commodity trades and all of these things building still, is that we have to not only look at this as, okay, we're here right now, this is what's happening, but also be cautious about what's going to happen in the future. And the other thing that I think is a big possibility, especially looking at the banks, and this would be very interesting because yields have been down for so long, would be because what really matters about yields isn't just the long end of the curve or the short end of the curve, it's the whole curve in general. So how far up is the 30-year going to move away from, if they start raising rates, is it going to be like 2018? Meaning in 2018, when we raised the short end of the curve, when the Fed started raising rates, the long end of the curve laughed and said, you're ridiculous, that can't happen. And bonds actually bottomed at that point and started moving up like crazy. So we have to keep in mind of, hey, what's going to happen when they do raise rates? Is it going to be a laugh off situation by the rest of the curve? Is the 30-year and the 10-year going to continue to move up with it? Or and to be bullish on the market, you want to see that move up even more than everything else. So is that the possibility?
Right.
Or are we going to see something else where it doesn't? And that's the time where we're going to really want to be more defensive in the markets.
Yeah, I agree. I particularly agree with a very important point you make, that like, even if you see the change coming, you can't position for it until price and time tell us. And I think that's a big thing that catches a lot of people, because, you know, we can think, oh, well, we're going to be smarter than the market and we're going to get real cute and position for what we think is probably going to happen. But, you know, you can be right and still be wrong. And, you know, you can be right on what to do, but wrong on when you're doing it. And if you stay wrong for too long, it can really start to erode your returns. So I think it is important for traders in particular, and, you know, for sort of full cycle investors to be aware of these kinds of things. And then, you know, not just like think about them and position for them, but have a system. And Jason, you have, you know, a very systematic approach to how you manage your trades that I think is worth talking about some more, because I think that's something that, especially in a year like 2022, where there's bound to be more emotion, there's bound to be more potential for noise amid the signal, especially within the flows of news and the narrative that kind of comes out from the financial media about which sector to rotate into and what's best for investors. And, you know, I always always read that kind of stuff when they get too excited as what kind of bag they're trying to sell us. But sometimes it really feels like you have to be very kind of logic oriented, taking out ego and just really putting everything into models that give us better probabilistic outcomes than just trying to kind of go with the flow. And I know that for a lot of folks that kind of started trading in 2020 sounds very foreign, because it was just buy the dip and you're fine. Just buy lottos and you just keep stacking and stacking. And we're not in that market regime anymore. That market regime is probably gone for a long time. And one thing that's worth noting is what was the death knell for it was in the back end of 2021. I want to say in November, there was the largest amount of call premium ever in the history of the stock market paid for equity calls, and the largest amount of put premium ever sold for equity puts. So there is this enormous amount of retail just mania going on, and it really kind of told people like this was the last hurrah if you were looking at those flows before everything really started to roll over even more. And a lot of stuff never recovered since late February or May that was in that sort of tech growth, high beta, long duration, rate sensitive area. But it feels like even still there's this sort of knee-jerk impulse out there, buy the dip, everything's going to be fine. And I think you and I have talked about this a lot, and really throughout the years, especially lately, that impulse at some point is just not going to work anymore, and people are going to need to find a different system to trade. So with that, talk a little bit more about a systematic approach to trading and kind of how you do it, because I feel like everyone, whether you're experienced or a novice, would benefit hearing about this.
Yeah, so in the first time it ever really hit me and made a ton of sense was, and I used systems before this, but when I really thought that everybody should have them and think of them not even as this is when I buy and sell, and you don't have to be even to the extent like I am. You can use it as kind of guardrails. And I was reading Hedge Fund Market Wizards, and it was the first chapter with Col Moshe. And the title was Knowing When It's Raining. And in there, he talks about the fact that everybody should kind of think of themselves like a CTA. You want to think of yourself as someone that when you're trading and you're in a trend, when it breaks trend, that's when you're out of the trend. And like so many people, everybody, and we talked about this a million times, everybody wants to hit the top of everything. You see a lumber chart and you're like, man, if I just hit that perfect top and I did that once, I would have made this much money. And if I buy Dogecoin here, all these ridiculous things. And you don't realize there's a bunch of different aspects of it. One aspect is nearly impossible to hit a perfect bottom or to hit a perfect top. The other aspect of it is, let's say you were that person, who bought a Bitcoin at $1 in, 2010 or whatever. And you buy Bitcoin at $1, you sell it up, you watch your, let's say you put $100 and you watch $100 turn into $100,000. And then it gets chopped in, I think that was 2014, and it gets chopped by 90%. How do you handle that drawdown? Did you just take it? Did you just go, that's fine, I'm great, I love Bitcoin this much? Most people, and this is what creates those panic bottoms at the bottom of bear markets, is most people sell at that point. The all the way bottom is when you are feeling the worst, you're depressed, you're upset, you can't believe you didn't sell perfectly at the top, and then you sell at the bottom. And this happens all the time. So instead, the idea of trend following, systematic trend following, is that you don't get in right at the bottom. So let's say you miss 10% of the bottom. Let's say you miss 10% of the top, but you catch 80% of the move. And the goal in trading and being consistent in the long run, especially for me, has been figuring out what the primary trend is and staying with that. Not trying to catch every tick up, not trying to catch every tick down, not trying to catch every single thing that's moving up or down. Like today was down a bit. If my systems would have come in and started shorting right then, that's not what I do. I sit there and, those down days are just part of a overall trend. So if you look at a longer term chart, like a weekly chart, you can see what a primary trend really is, and kind of understanding those primary trends and understanding like you're not here to make every single penny, because that's impossible. You never will, but you are here to catch the meat in the middle. And if you can do that, you can make a lot of money.
Yeah, that's a really good point. And I think, in particular, the psychology of how a lot of people are, either buying those tops and kind of getting seesawed and really emotionally jerked around, and either selling those bottoms or, holding on and then selling at break even, which is another thing that seems like a lot of folks try to do. They get kind of whipsawed one way or the other, and they just take it at break even if it's back into an uptrend, even if it's about to trade higher or probably will trade higher. There's a lot of that kind of stuff going on too. And so I think you hit on a very good point. Trend following is really about trying to capture the bulk of the move. And that really should be every trader's goal, because you're look, I mean, you can get lucky and you can definitely catch a top, but to try to like make that your style, that's so hard. And it's just, the probabilities are against doing that. It's not something that one can reliably do, no matter how good of a trader they are. It's like, you're really going to catch a more reliable top after it's shown us it's a top, not at the top when it can keep going up and up. So, I think that's really important. And it's the same thing for catching bottoms. And I know a lot of folks out there, because the buy the dip impulse has been so thoroughly ingrained in this market, they're coming in on days like today and they're just buying the dip. And, sometimes it works out, sometimes it doesn't, because it had worked out for so many times versus times that it hasn't, that the impulse is sort of very well ingrained into a lot of people. But, if you kind of extrapolate upon that, I guess it comes down to, risk management, position sizing, discipline, understanding the time frame of the trade. Where's your risk level? Are you just averaging down? I think Mark Minervini said, and I think this is a really good point, you really shouldn't be averaging down on this kind of stuff. He doesn't average down on anything apparently, but I really think that's a pretty good approach, because once you get in the habit of doing that, especially if you're not doing it with any kind of rhyme or recourse, like, if it's a long-term investment and you're dollar cost averaging and your investment thesis is intact and it's a 3 to 5 year time horizon and you're just doing your monthly average, that's one thing. But if you're trading something with emotion and you keep buying the dip and buying the dip, hoping that you're averaging down to kind of catch something resembling a bottom, that usually blows up accounts. And so, I know a lot of folks out there are struggling right now. I hear the stories. I know that people have gotten very enamored by some of the stocks that are talked about the most on places like FinTwit and YouTube and StockTwits. And, my greatest advice to anyone that's out there doing that is to take a step back, understand why it is you're buying or selling what it is you're trading or investing in, and make sure that you understand the thesis, that you understand the conviction, that you understand your risk, and that you're managing that before your reward, and that you're sizing your positions accordingly so you can sleep at night. Because the biggest thing I hear is people are blowing themselves up with too much concentration, too much leverage, and really not having any kind of risk management strategy. And I think there's a lot of ways that this market, even though it's difficult, can be a good market to teach people about what a real stock market looks like, because it isn't just all up. The whole stocks only go up mantra, it was really just about a wall of liquidity chasing asset prices higher, and markets aren't typically like that. So earnings start to matter, the health of the economy begins to matter, and what the Fed is saying and doing starts to matter a whole lot more. And I think that those are also things that, for folks that weren't paying attention to macro and weren't paying attention to some of the sort of finer details of company earnings, they really started to miss a lot of these important details. So, never a bad time to take a step back, look at studying, learning, getting better. A lot of the time I will say, and Jason and I have talked about this too, and this is important, like everyone has bad times when you're getting kind of going in the world of trading. A lot of people blow up their accounts. Some people have big drawdowns, many times more than once on either end of those spectrums, and there's nothing to be ashamed of in that. You just need to understand where you went wrong, why, and how you can improve upon that. In fact, the best traders I've ever met have had those experiences, and it defined their risk management style and the appreciation they had for risk. So when you feel like sometimes it's time to give up and you're just going to throw in the towel, actually actually that might be where you're getting closer to realizing how important it is to manage that risk and applying that to your trading style, because you got hurt, you're bleeding. And the other thing that just to add on to that, but a lot of people also say when they go the other end of the extreme, I'm not going to give up, is they try to get all that money back too quickly, and they take on bigger and bigger risks and can end up blowing their account up that way too. So it's a balance, right? We've got to be careful about letting emotion intervene with our execution and our returns. But that's why systematic trading is so important. And then, Jason's been talking to me about systematic trading for over a year now. I've been applying a lot of those ideas to some of the techniques I use for my longer time frame trades and investments, and I've had good success with it, because you're already going into this with a back-tested strategy to understand where your risk and reward is, to understand where potentially opportunistic entry and exit might be, and you kind of get into these trends, and then you basically you leave them when the trend's no longer valid. And that's a system that takes all the guesswork out. It takes out all the emotion, and you can be wrong more than you're right and still win in big ways because you're managing your risk really closely. So, that's just something I wanted to touch on. I appreciate you talking about it more, Jason. I think this would be a good segue to kind of talk about some of the things that we're looking at as 2021 goes on, because it does kind of feel like we're late cycle. This cycle, if we look at it as starting from April of 2020, it's been kind of a compressed economic cycle. The wall of liquidity that entered markets happened with such velocity that it really pulled forward a lot of demand. It pulled forward a lot of the repair and the recovery cycle. And now we're clearly in that expansion phase. And it seems like we're even late in that expansion phase. So I know you touched on it a little bit earlier about kind of being nimble, more watchful of some of the things you see coming down the line. But what are some of the trends that you have your eyes on, things you think might be happening next?
Yeah, so basically there's a couple things to always think about when you're going to be a good trader, which is you have to really stick with trends. Yeah, the one thing that we really do know is that trends persist. And what does that mean exactly? So you have to once define your time frame, define your what drawdown, how big of positions, and so on. So you have an understanding of each asset you're going to trade in these markets. But when we're looking at this, what I'm still seeing is that nothing's really changed from basically my regime model's telling me nothing's really changed from November 2020, which sounds absolutely insane. But if you really look at it from a top-down view and a macro angle, you can see that things like energy, things like the financials, these to me are financials are the most important sector. They can tell me, I could really look at KRE, which is the regional bank ETF, and I can get an idea of everything that's going to happen in the markets. When that's underperforming, that's usually telling me that sometimes gold's going to do well. Sometimes bonds are going to do well. The commodity currencies are probably a short around those times. Commodities in general are generally a short around those times. And then when the KRE is doing well, I can generally say, okay, well, we're seeing that energy should catch up or start doing well. We're seeing that materials should start catching up or doing well. And this is kind of a great way of kind of building your first regime model. And so for me, I use a fundamental model, which this uses things like the ISM, PPI, and so on. And then I use my model, which is all based on trend following trading. So, and then I have a relative model. Relative model means relative strength against the S&P 500. So if I'm looking at something like consumer staples against the S&P 500, I'm noticing that those have not been performing well for a very long time. And so when we're looking at those from a one-year view, we're seeing consumer staples are down in the bottom 5 S&P sectors. XLV, which is healthcare, it's in the bottom 5 sectors. XLU is in the bottom 5 sectors. These are safety trades, so meaning that when everything is going bad, this is where people usually run. People do not run into energy when the market is going to fall apart soon. People do not run into financials when the market's going to fall apart soon. So just understanding that little bit of the market can kind of help you go, okay, well, these dips are still viable in this market. Now, once again, we're not talking about just buying crashes. There's a way to buy mean reversion trades. That doesn't mean you buy them as they're just crashing down and down again. You can look for a candlestick signal, being a hammer or something like that. You can look for a movement to get back up and over a certain moving average. You can do many different things to kind of get into a trade like that. But looking at the overall regime and the environments, we're still seeing that the sectors are still holding up in the high beta areas. We're looking at values kind of taking back up again. We're seeing yields on the long end making a run, and they're up and over 2% again in the U.S. If you look at even the UK, gilts have done very badly too. So yields are going up all over the place, and we're seeing that the market is still saying exactly what it said in November 2020. So this is completely against of what we're seeing in the fundamental picture, which is, if we're looking at the Fed, they're saying they're doing certain things, they're going to do certain things, and they will at some point. But right now, the market's kind of calling its bluff on that. Now, the market isn't always right, but a lot of the time it is. A lot of the time it is, and if the price is kind of telling us something, we really have to listen to it. So looking across the board, looking at the commodity currencies starting to move up. Now, the dollar made a big run, but a lot of people don't realize the dollar is weighted 60% against the euro. And so being 60% against the euro, we're seeing this major, the dollar looked like it made a major move. But if you look at the other commodity currencies like the Aussie dollar and so on, especially the Canadian dollar, you're seeing that it doesn't look that bad. So this picture kind of looks identical to November 2020. Now, do I think it's as lucrative as November 2020? No, I do not at all. I think there was a major time when we started buying the energy stocks and so on that we had this amazing opportunity. But is there still something moving here? Yes, I think so. I still see all of these trades and the commodity trades still working out, as you brought up earlier, which was on the fact that the Fed cannot print more copper. The Fed cannot print more oil. They can't make these things happen. So all of this is going to be kind of a choppy road for them to get in charge of it. But the one thing I always think about the Fed, and this is borrowed from Richard Russell, which is the great Dow theorist writer, and he would always say the Fed always has a choice, and it's inflate or die. And I really think that the Fed will always choose to inflate. Where that inflation goes, monetary inflation, what we're talking about, where that money printing ends up going into, that can change. And that can change based on environment. Sometimes it'll go into stocks. Sometimes it'll go into real estate. Sometimes it'll go into gold. Right now, it seems like the best sector that's the most undervalued relative to everything else is still commodities, even with this major run. So we still could see a lot more room to run here in these sectors and in the commodity space. So once again, it's something that I don't want to get too far ahead of myself and start, chopping off positions or whatever. I would rather sit there and ride something like oil that's made this major move all the way from, I think it was from $30. The last trade for us was $30 all the way to, I think where we're at today. And I'd rather wait till that really breaks trend and wait till all of these things really break trend until I start really saying, okay, maybe it's time to start moving into something a little bit different.
That makes a lot of sense. And I've kind of looked at it through a somewhat similar lens, in that I'm kind of waiting for the market to show me that it's ready for a different regime, right? Like, we've had this sort of preference towards cyclicals and reflationary plays on and off, but mostly on, especially the back half of 2021 on. And it seems like that's not only kind of making it pretty clear that it's an ongoing rotation, but it's accelerating to some extent with the amount of money flowing out of tech and the amount of money flowing into, in particular, energy and financials, and especially the first week of January, when we're getting those beginning of month, beginning of quarter, and beginning of year flows from institutions. They were kind of voting with their money as well. So I thought that was really interesting to see. It was adding on some of the biggest winners of 2021, like I think Devon and Marathon were the top two of the S&P 500 500, and they're continuing to perform pretty well here. And it seems like, as you hit on with rates, it does seem like we're in this regime where the Fed policy decisions, the framework they're going to undertake, the sort of triple threat of taper, tighten, and QT are starting to be re-evaluated a bit. And that is to say, we are not quite at a point where the market's fully pricing in the full policy normalization that the Fed seems to be gunning for, around 2.5%. I think the last I checked, that terminal rate for the Fed was still being priced a bit under 2% or just close to it. And, we still aren't quite yet at positive real rates. So those are things that I'm watching, because I think that, once we get to that point, we start to see some of that Fed policy priced in by markets, and markets might become just a little bit more sanguine in the sense that they're beginning to, digest these policy changes. I think of the Fed meeting that we see on January 26th, the policy, which I don't suspect they're going to change anything, but the meeting that comes out of it, the press conference, I should say, that comes out of it, and what they talk about in their statement is going to be pretty important to markets. In fact, I think also just looking at this week, this is just a rather incredible week for macro. I don't know that I've seen a week with so many different things going on at the same time for a little while. We've got things like Powell testifying tomorrow, which is a pretty big deal, and that's on top of Mester and George. We've got CPI on Wednesday with a 10-year bond auction, just in case the CPI wasn't enough to jolt credit markets a little bit. We've got crude oil inventories in beige book the same day, then PPI on Thursday with unemployment claims and a 30-year auction. I mean, that's just jam-packed. And then Friday, you've got retail sales and consumer sentiment. So this is going to be one of those weeks where, there's so many event volatility catalysts. I think coming into today, we saw some of those hedging flows getting ahead of some of this stuff happening, as well as we saw some pretty big put buying. We saw a spike in volatility, and we saw from the intraday put call ratios, getting well above 110 or 1.10, I could say, really showing that there was a lot of demand, especially the index level. So maybe that skew, we'll see when that skew number comes out later, but maybe we did get a little bit of a boost in skew today. It certainly feels like there's a little bit more consternation among institutional market participants. And, when we have the skew drop off like that, the other thing that changes is some of those passive flows that help to bid equities up kind of dry up. So those Vanna and Charm flows that are a result of outsized institutional hedging and, trying to decrease the perception of value at risk to increase buying power. Once that skew comes off, that actually has a pretty negative impact on those positive flows that come into the market. And so that's another thing. And when those flows have been happening has changed, but also because of the lower skew, how much of them has changed. And we're below that zero gamma level on the S&P. So we also have the possibility that if those flows do come back through in any way, that they're going to be buying rips and selling dips and essentially exacerbating volatility until we get below, back above that zero gamma level. So we have, optionalities playing a role in some of this. We have this sort of this leptokurtosis, this fat tail distribution of risk we keep seeing. So, I think for traders out there that are trading the indices, if you're trading them intraday or if you're doing swings, it's probably smart to use smaller position sizes. If you're using options, it's probably smarter to look at whether or not the premium is there, that it's worth even doing vertical spreads or calendar spreads. Right now with skew lower, it might not be worth it. So hedging strategies kind of change a bit here too. And one thing that someone wiser than me once said is, don't buy hedging when you need it. Don't buy your hedges when you need them. Buy them when they're cheap, because you don't really know when you're going to need hedges in any market. We don't have a crystal ball. We can be great traders and investors, but it doesn't mean we're going to know what's about to come down the pipe in terms of macro data, earnings, technical price action, order flow, et cetera. We can just sort of model for probabilistic outcomes, and that's also another reason that I think systematic trading makes a lot of sense, because it helps you to have those systems in place before, so you have a method to react to them rather quickly and not really wait for a chance to pass us by. So Jason, when we're looking at regime changes in the market, when you see a sector for example, like if you're looking at the equity side of things, if you see a sector, let's say we've got top 3 sectors, and let's just say it's something like financials, energy, and industrials. When you're going long a sector based on systematic trend following, are you going long like a sector-based ETF? Are you going long commodities that serve that sector? In the case of like energy, looking at crude, or are you going long individual equities or ETFs or all the above? Kind of how do you play that?
So I think of myself as a true macro trader, which means I trade everything. It doesn't matter to me what it is. There'll be times where I'll look into, let's say, like you were saying, industrials. Maybe I find something I really like in industrials, and I like the sector. But let's say the best course of action for me at this time is there's some earthquake in, let's say, Japan, and I want to buy industrial companies in this area. I will put together every single piece of it and do whatever is necessary. But usually when I'm talking generally, I'm talking about the futures system. So and in futures, I'm using their sector futures. If most people don't actually know that, and most people don't trade them, they're very thinly traded, but they are very tradable. They are liquid, where you can trade all of the S&P sectors. You can trade real estate, builders, consumer discretionary, tech, financials, energy, industrials, consumer staples, communications, and so on. And these are all in that area. So when I'm looking at these things, I can do this in many different ways. And I kind of also set up so I have 2 different styles of my portfolios. So I want to have, and I think this is important for everybody, because especially if you are a person who's like, okay, I have options, I have futures, I have stocks, just so you can kind of separate your money and understanding, like, if you're in futures, your returns are going to be larger, but your risk is most likely a little bit higher. And then if you're in individual stocks in like a long-term portfolio, your risk is going to be much different than futures. And then if you're trading options, your risk is even different than both of these. So you want to at least have 2 different portfolios to kind of switch these things up. So in one of my portfolios, I'll be trading things like we have fertilizer companies, we have coal miners, we have copper miners, we have all of these things in all of these different areas in one style of the portfolio. And then in the futures portfolio, we're focused on the commodities, the sector futures, the bonds, currencies, you name it. So there's lots of different ways to express each trade. Like, for example, if I'm talking about an oil trade, you could express an oil trade in the Canadian dollar if you're a currency trader. And if you can also express an oil trade as in a short bond position. So there's all types of different ways to do this, especially as a macro trader. But I think it's so important, and the most important thing of what I'm saying here is that you want to be able to shift asset classes and things you trade constantly, because you never know where those opportunities are going to be. And if you're consistently going, like, for example, and this came up, this is on Twitter, and it was a buddy of mine who said this, and I was kind of confused by his statement. And he was talking about the fact that if you are trading, if you did good last year, this market was terrible, and you're lying if you did that good last year, or you got lucky. And really, to me, the market was very smooth in 2021, and I'm probably one of the only people who would say that, but it's because I didn't own any tech. I didn't own any tech, and tech didn't do badly at all. It was just certain areas of tech were choppy, and I know most of the people had a lot of trouble were trading like small tech stocks, and they were sticking with the things that they were doing back in early 2020 and 2019 and 2018 that worked very well, and they didn't venture out. My system shifted completely. And a lot of the people in my group, they knew me from 2019 when I was I was long utilities, I was long real estate. I'm actually still long that right now. I was long healthcare at certain points. I was long consumer staples. I was short commodities, especially oil, and I was very long the bond market. So it's the the complete opposite portfolio setup that I have today. And I think that's part of the reason why I can shift easily into different things and kind of, and it doesn't mean trading is easy. Trading is never easy, but I can kind of be in those sectors that are stronger and that are going to give me a better return and a smoother ride than constantly trying to just get whatever out of whatever stocks I want, because that's the thing. And at the end of the day, none of us can make the market do what we want it to do. So the only way to do it is kind of go with the flow, surf the waves. And the waves, as it moved into the reflationary trade in November 2020, we shifted completely into that direction, and that's the way we're sitting right now, and we've been capitalizing. And I think a lot of people, especially like when it comes to commodities, and I hear this a lot from fund managers, especially like portfolio managers like myself, like we deal with this and we hear from other people all the time, and they tell me that their clients wouldn't like them to buy the things I buy. You know, if it's not sexy to buy coffee, it's not that sexy to talk about like canola oil, you know, or lumber or soybean oil. You know, there's nothing in there that anybody goes, man, that's such a great trade. You're so cool, Jason. You're so smart. You know, nobody cares. They're like, you can trade that. I mean, most of the clients I talk to, they think I have like a grocery store or something. You know, they don't understand like that. This is this is just another trading vehicle, just like anything else. There's you can trade. Most people understand they can trade gold, so you can trade gold just like you trade wheat. And there's even ETFs for these products. And so, there might be there's always a bull market somewhere. And so while you might be having a lot of trouble with tech stocks, you might find a very smooth ride in financials with major return. You might go, oh crap, I could have bought oil last year and it just, had a great year. Soybean oil had a good year. So you had all these trades in all these different areas that nobody even really messed with. And at the end of the day, like, I think if you can't shift from asset class and different sectors and so on, you're gonna get killed at some point, because you just can't. I made a joke about it the other day, but it was very true, which is like, if you're a basketball player, if you watch a game, most basketball players, and if you look at their stats, they shoot at about 40% from three. And I said, if you live and die with nothing but 3-pointers on your entire team, you could win some games, but at some point you're going to get your ass handed to you. And that's the absolute truth, because tech stocks did very well, and the FANGs did very well, and they could continue to do well. I'm not saying that, but the point is that if you're not able to kind of move away from that and understand that there's lots of different ways to trade and lots of different things that make money, you will get your ass handed to you at some point. So be very nimble when it comes to these things. Be able to kind of see all these different asset classes. So I harped on everybody last year about, like, please learn how to trade futures. Please, for the love of God, learn how to trade futures, because if you want to trade things like commodities, there's no better place to be. You can't trade oats in the market. You can't trade all the different currencies we have. Palladium, you can trade palladium, but it's very thin. You got soybean oil, you got canola oil, you've got all these different, you got iron ore, steel, all these things that are overseas. You can't trade any of these in the normal market. So if you can at least kind of understand and if you don't, and that's okay too, if you don't have, I started with a very small account when I started as well. So if you don't have the money to trade futures, that's okay. But look at it and also know in your head that at some point you will get there, to the point where you're trading futures and being a good trader in all these different products. So looking around and identifying those things is also very important to me.
Yeah, I think that's a good point, especially being versatile, knowing, how many tools we have out there and getting familiar with those tools. I mean, different assets kind of have different personalities, but once you start to learn how these things trade, what kind of volatility to expect, what moves them, and having systems in place to manage those trades, it really does start to take on a life of its own in a good way. And I think that's one thing that you really hit on that's so important, is that, a lot of folks get very comfortable with a certain certain asset or a certain stock or a certain sector that's treated them very well, and they become almost kind of willfully blinded to some of the other stuff that's out there that can be good opportunities in this market, whether it's on the long side or the short side, whether it's in stocks or futures or other areas of market options. Potentially there's always an opportunity setting up somewhere. And I think that if anything, it's really kind of amazing that we have had so much retail participation in this market, so many people who have been trading and investing who never had before, a lot more people that are younger. I think all that's great, and what I'm concerned about is that when folks don't take the opportunity to really learn strategies that aren't conventional in their circles, but are how you really, over the longer term win, like you talked about, being not only willing, but able to trade any asset, really being able to get into these opportunities and identify them as they're happening, and not trying to call bottoms or tops, but capture the bulk of the move and managing risk along the way. I think that, a lot of people who are feeling very discouraged and beat up, this is the time to say, well, what I was doing wasn't working. It's time to shift gears into a new strategy, and it's time to look at all these amazing different tools I have at my fingertips, because we're kind of spoiled in the market as retail. I mean, we have, not only are we minnows and we are swimming with sharks, but we can move small enough size that we don't affect the market. The market's very liquid for us. We can get in and out of positions very easily if the positions themselves are liquid, which, honestly, if you're retail, you shouldn't be trading in liquid stuff anyway. But nevertheless, the other advantage that we have is that we have so many different products now that trade. So even if you don't have an account with futures, you can still get all these different ETF products. There's a lot of different ones out there that are actually pretty low fee and liquid and trade well and give you access to markets we never had access to before. And that means the potential to harvest alpha or even scrape beta is much higher than it used to be for traders. And so this is 2022 is probably going to be the year of the trader, in terms of what it's been like and what it may continue to be like. And certainly every year can be a good year for traders, but in particular, when you have a lot of volatility, when you have a lot of chop, when you have these sideways to down moves, investors don't tend to do as well in that kind of environment, but traders can actually, do pretty good in that type of environment. They can do pretty well as long as they have strategies where they're continuing to govern their risk and manage changes as they're happening in the market. And, a lot of the time those regime changes do happen during down markets as well. So that's it's important to look at what's going down less, what's even green on those down days, to get a sense as to where that relative strength is over a daily, weekly, and monthly and quarterly time frame, because we can really see some of these changes playing out. And I think that 2021 it's like a segue year. We had a little bit of column A, we had a little bit of column B, we had a lot of upside participation from the more established mid cap and large cap techs and growth names, but we also had a lot of flatlining and even capital destruction in some of these smaller, more speculative names. And I think that was kind of telling us that the floor was starting to come out of the sector, of the factor, right? As the year went on, as we're starting this year, we see, Microsoft's down over 6% in like the first week of trading, even through today. You have other stalwarts of tech like Apple's down over 5%, Google's down close to 5%, Amazon's down over 5%, Tesla's down close to 12%. So, underneath the surface, while all these financials and energy stocks and some of these healthcare and industrial and material names are getting bid up, there is flows, or there are flows coming out of some of these larger names and a lot of these tech names, and we can see that they're going into these other sectors. So that rotation is very real. It's something that is not only institutional appetites, but it coalesces to reinforcing where we are in the credit cycle and where we are in the resulting allocation preference for different market participants. Because as real rates rise, the threshold from which market participants are willing to take on longer duration risk diminishes. That appetite for more speculative assets really has to erode, because now there's more opportunity in different parts of the market. And if we go from a point of real rates being negative on junk debt and corporate debt and mortgage-backed securities and even treasuries and all that kind of stuff, if real rates go pretty deeply positive, then all of a sudden we go from an environment of return-free risk in fixed income, where there is no other alternative but stocks, and to some of the more volatility tolerant things like crypto, we could actually get into a market where fixed income is no longer on life support. And if we do have that, it's going to create a bifurcation in flows, because a lot of retirees that have made a lot of money and are increasingly nervous about the equity market, they may start to choose to go into fixed income instruments that they perceive as being less risky. Whether they are or not remains to be seen. But certainly that's going to be another potential pivot if indeed rates continue to march higher and people are able to get positive inflation adjusted returns on these different instruments. So I think we are in a market dynamic that is one of the most interesting I've seen in a long time, not only because of how quickly this cycle has played out, but also because of the extremes all along the way, and a lot of the sort of fake back and forth thematic rotation preferences we saw in 2021. I mean, it was a year of indecisiveness. Underneath the surface, there was certainly a strong preference for the more cyclical plays, but within the sort of media narrative and within what a lot of people on different sides of the value and growth investing space were talking about, one saw a tug of war playing out, both to try to control the narrative and also to try to salvage some of these things that were getting beaten down, as there were a lot of violent rip your face off rallies killing shorts too. And this seems like a year where that reflexive rally in some of those stocks, at least for now, is not really happening in the small and mid caps that used to bounce back higher. It seems like there's a lot of capitulation in that space and people moving to areas of the market where they think their capital will be treated better. And it also feels like there's more folks that are just shoring up cash. We saw a lot of ETF unit destruction and distribution from some of these market tracking funds at the index level. And we also saw just enormous outflows from treasury funds, especially last week, where the carnage was pretty historic across that market. And it's pretty interesting too, because a lot of that action is bear steepening. I mean, these are the longer end of the yield curve is rising faster than the shorter end. And that's putting a lot of pressure on that same kind of stuff. The velocity of rate increase and where some of those rates are going is really starting to hurt things like precious metals, tech, crypto, growth stocks, biotech, et cetera. And so, it seems like the market is starting to reprice a world where liquidity is somewhat less abundant, where, and as a result, risk appetites are somewhat less speculative. And, that has a fingerprint in what we're seeing in the market and where things are going. And it also, I think, means that for everyone that's a market participant, we can't do anything other than really follow what's happening and really try to benefit from it. We can't try to pretend we're smarter than the market and we're going to catch this falling knife. I can't tell you how many people I know have hurt themselves very badly trying to call bottoms in this. And it's like Jason said earlier, you can't hope to just call bottoms just by saying it's true. Like, you might think it's true in your mind. Maybe this company's trading it at what seems like a cheap valuation. Maybe the technicals look like they're at a level that had bounced before, but cheap can always get cheaper in any market, bull, flat, or bear.
Absolutely.
And so it's it's so important that everyone realizes that, because I know we all want to feel like we're smarter in the market. It's gratifying to have a great trader investment. It's gratifying to make a lot of money. But what's more gratifying over the long term is to have consistent returns and a repeatable system that makes money.
Absolutely. That was perfect. And when we're looking at these things, and also you have to keep in mind certain things, which is you have to have some way of looking at the market that is an area where you do not get in anymore, right? Like, if you're looking at something like, simply put, and I really dislike 200-day moving averages because everybody uses them, but I pay attention because everybody uses them. But something as simple as, okay, it's under a 200-day moving average. I don't go long under this zone. It's over the 200-day moving average. Okay, I look for buying opportunities in my system over this zone. Now, a simple filter like that for a trading can be very good for you, especially if you're on the shorter term side of trading. You're not looking for these things. You're not trying to catch perfect bottoms. You're trying to kind of get into things and catch these swings. And the easiest way to do that is to do it that way, because the important thing is, even companies that are fraudulent or terrible, most things, stocks, bonds, commodities, whatever you name it, they don't top and just crash to the bottom and never come up again. That's not usual. Usually when it's in an uptrend, and that's can be simply, you don't have to use the 200-day moving average. I use that as an example, but simply as this is making higher highs and higher lows, most of the time when you see that scenario, it's very, very rare and almost unheard of for a stock to just go down forever. Now, like I'm talking in the large cap space, sure, in this very small and micro cap space, yes, things like that can happen. But if you're looking at a macro space and most of these things, you're going to see these things start to roll over before anything like that's going to happen. So simply, you can kind of go, okay, well, this is a way for me filtering my brain out, and you can back test this and kind of see, okay, well, I'm looking at a weekly chart. I'm using a 40-week moving average. When it gets under that 40-week moving average is when bad things happen. When it's over that 40-week moving average, good things usually happen. So my systems, when I go long and I buy, let's say you create a very simple system. You have I actually have a system like this. It's called buy the dip system. And it has a stochastic and it's a 60-period stochastic. And when that's above 70, and I have a Williams percent, which is a 10-period Williams percent R. And when that's all the way oversold, and then the stochastic is holding above 70, this is a time, the first day it moves up, I will buy. And that system works very well. But once again, you have to have that filter to make those systems work right. So these are all kind of ways you can kind of like save yourself from destroying yourself in these markets. And this is what we were talking about, where you have all these people, and especially like, we talk about this all the time. You got all these people online and they're talking about how they've never made a bad trade and they've never lost money. And then you look around and you got 20 friends of yours who are saying that they made so much money on Dogecoin last week and they can't believe you're so stupid and you didn't buy it, and all these things. And then you look over like a long time range and you go, well, crypto didn't really do that good last year. You look over these
right.
things, like, how exactly did they do this? But they tell you, oh, it's down now, but it's gonna be up soon, and I'm just gonna hold on until it goes up. These aren't traders. These aren't people who actually consistently know how to make money in the market, and that's what we're talking about here. We're not talking about gambles. We're talking about how do we be consistent in making money in the markets, and these are all great ways of kind of tuning your systems to make money in the markets consistently.
Yes, and I think that's also a really good point. And we do see that. And you know what? I think we should just take a moment to address that too, because I know that we're going to have people of varying backgrounds listening to this. And I've had many different experienced traders. I mean, we've talked about this, and other folks I talk to on the regular, have talked to me about this too, that it's a little jarring to see the hype about how much money is supposedly being made. Some of these trades seem like the fills are impossible, especially when I see some of the options prints that people are saying they get. I mean, I've traded enough options to know that some of these stocks are just, you're not going to get it. The slippage is too high. You're just not going to get that good of a fill. You're not going to get that kind of return. And if you do, something magical happened that's more of an outlier than, a repeatable phenomenon. And then on the other side of it, people don't talk about their losses and the lessons that they've learned, which quite frankly, if you're on a public forum and there's people of all different skill levels there, it's almost more valuable, if not more valuable, to talk about what you did wrong and how you could do it better than just gloating about what you did right and not even knowing why it went right and talking about that part of the thesis, And I think that's in my consternation that I see a lot of the time on places like FinTwit and StockTwits, especially because there's a lot of just sort of, blowhard, egocentric, puffery. And that stuff doesn't matter. Like, sure, it feels good to be right, but what matters really to me, and I know to you too, and to a lot of the other people I talk to, is trying to help others, trying to pay it forward. We weren't always proficient traders. We weren't always, skilled investors. And so we're trying to help other people. And when people go out there and they put this nonsense that, all you got to do is buy this no-name crypto token or buy some lotto options and this or that or the other, you're not teaching people how to make money in the market. You're teaching them how to become speculators that might blow themselves up, because not only are they taking outside risk, but they don't understand what they're doing, and they can't repeat whatever it is that might make them money if they get lucky. And I think at the end of the day, it really is important for people that want to succeed to develop an approach that not only is something that you can document, that you understand, that you can explain to someone else in a short amount of time, and show it on a chart or presentation and explain it to anyone, but also something that you can continue to get better at, something that you can continue to learn and iterate and improve on, because no approach is perfect. We can get better and better, but we should never settle. And the market's always changing too, which means we need to keep refining our approaches, right? So I like that there's so many great people out there that want to try to pay it forward. I owe you a lot of gratitude, Jason. I owe a lot of these other people a lot of gratitude for sharing so much and being so generous. But I also want to just gently discourage people who are out there and just kind of spending all their time bragging about stuff, taking pictures in front of fancy cars, looking at all this kind of returns, whether they're real or not in their portfolio, because that's not helping other people out there become better at this game. And this game is only getting harder. So there's a lot of people that are throwing in the towel. I see it every day. I see people deleting their accounts. I see people, talking about how they tried to follow so-and-so into a trade and it didn't work, and now they're going to quit, or their wife's going to, divorce them or whatever. I mean, there's a lot of stuff that happens because people aren't really doing it on their own. They're really relying too much on others. And sometimes the people that are out there are just using you as exit liquidity, right? And if that's the case, that's a big problem, because they're just selling to you, and you're buying their whatever it is, and pretty much providing them a path to get out at the price they want. And that's not an uncommon thing. We see it all the time when people are pumping these low float stocks on FinTwit and blatantly saying, buy this, it's going to whatever, and they're probably selling it at that point. So be careful out there. Try to take the things that Jason and I are saying to heart, because we've had the ups and downs of cutting our teeth in the market. We understand in no uncertain terms, and we're humble about it. We don't have a big ego. If we do well, that's great. If we do badly, we're not going to let it ruin our day either, because at the end of the day, you shouldn't tie your P&L to your emotional well-being. You're going to be more likely on good days to make bad decisions, and on bad days not to take the kind of risk that you might need to take, and if you're trading on longer time frames, just extrapolate that accordingly. But always remember that there's opportunity in the market. So if you feel like, oh gosh, I'm never going to bounce back, I mean, I would say almost every day there's a new opportunity, certainly every week and every month. And as long as we're willing to be students of the market, so that we're all going to pay tuition, it's our choice as to whether we learn the lessons being taught. As long as we're a student, we can do well. The moment we think we know better, or the moment we're just not willing to learn anymore, that's when we're going to start to get into real trouble.
Yes, absolutely. And that's something that does need to be talked about more, because we have so many people out there that do this constantly over and over again, where they're just pumping everything up, saying how great they're doing, like you said, taking pictures in front of cars that they probably don't even own. Because honestly, I work with a fund, I'm a fund. I meet lots of people who are wealthy. None of them drive around crazy cars and take pictures in front of it and show everybody, nobody would do that. Most of the people that the richest people that I can think of drive very normal car. You would never even guess what they have. And that's there's many reasons for that, but also, thinking about what you said too, which is your emotions. And if you look at anybody who's a really great athlete, I watch a lot of basketball, so that's what I can usually relate to people on. So like somebody like Kevin Durant, you watch Kevin Durant hit a game winner. He's not throwing it, the ball. He's not ripping his shirt off. He's not high-fiving. He's not chest bumping. He's not, making a crazy face. Same with like somebody like Tim Duncan or something. That's just what they do, and if you're getting too high, like that, like every time you don't make it, you're going to want to kill yourself. Every time you make it,
right,
happy. And that's the thing. You can't have your happiness wrapped up in things like that. This is just trading is you able to execute your plan. And even, something like learning something with like what I'm talking about, my style of trading, where you have a regime model, even learning that's going to have a lot of bumps and bruises. But really the whole thing is you really have to figure out your methodology and then just be the best at that. Just constantly every day come in and go, okay, I do regime models, I do this, and this is what I'm going to do, and this is when I take trades, this is when I don't take trades. And you do this over and over again until you refine that skill. And that's really mastery. If you think about it, like people don't, whether it's football, basketball, I rode BMX bikes, like you don't learn every single trick to ride a BMX bike well. You don't learn every single trick. You do the things you do and you do it well and you do it better than everybody else. That's how you do things well. If you watch somebody on a basketball court, they get to their spots. Certain quarterbacks really like passing over running plays. Like this is all important. So you got to figure out what you do and what you do best and consistently get into that and do that over and over again and dissect yourself. Because like you said earlier, emotion is so important when it comes to trading, that if you're having these emotional ups and downs and all these things, you're never going to trade well. You're going to sit there and second guess yourself on the trade that could have been the one that really worked out. For example, this is part of the reason why position sizing is so important. So with what I do, I'm at each loss in my portfolio equals 1% of my portfolio. So if I have a loss, I lose 1% of the portfolio. Does that hurt anybody? No. Usually anybody can take a 1% loss in their portfolio and not be that upset. So if you consistently do this over and over again, and let's say your average winner makes about 10%, your average loser loses 1%, that means you could have one winning trade in 10 and still be okay. So this is so important when it really comes to it. And I think this is the most important part of trading, really, is just understanding that. And I don't think it's the most important part of trading for the reasons that everybody else does. I think it's when you start trading, you have to stay alive. And because you don't learn through not trading, you learn through trading and trial and error. And the only way to stay alive is really to have that risk control, really consistently do this. Okay, well, cool. My average winner makes 10%. My average loser loses 1%. You do this over and over again as the years move on. Wow, you've had some major wins in there. And not to mention my systems are a little bit different than even that, where I have my trades are all looking for outliers. So as I'm looking for outliers, these are these huge moves. Like think of silver, jumping from, what was it, near $10 to 30, Bitcoin making its 10K move to, I think it hit 65, it sold out at 55. Catching these huge outliers are how I trade. And so for me, it's even crazier where, and this is how you could build a system too, is where you go, okay, well, I have this major move here that made, let's say it made, it's a huge trade, like the Bitcoin trade, 500% or whatever it was. It was crazy. But you get out of that trade and it makes, let's say, 50-60% of your overall portfolio. And it gains a 56% gain. So if I'm only losing 1% on my losers and I made 50-60% on one, like, so now how many trades do I have to lose to really lose money? And so this is a very simple way of just kind of the math making sense to you to consistently kind of put on these trades, consistently do well. And I'm making it sound easier than it is, but it also isn't that difficult to just kind of, this is exactly how I do it. A bond position, I can have a bigger size in a bond because there's lower volatility in bonds. Bitcoin, I have to have a very small position because it's the highest volatility product in history. So, so to lose 1% on each of those, I have to take these sizes and make them a little bit differently. So this is something that, I'm giving you a very short primer on this here. But if you can kind of go through this over and over again and learn how to do this in this way and be this type of trader, this is how everybody on a professional level does it. And most of them do even less risk than I do. Most of them do, they're risking 0.5, 0.7 per trade. And, you can dial it back, you can dial it up, whatever you want. As you're starting, I would always suggest the lowest risk possible. But once again, it's a road that you're going to have to go on. And on the fact of losing confidence, I had there's a buddy of mine who's a guy who talked to about trading all the time. He said something about fading me. He's never going to fade me again because I had that bond short position, and he thought that bonds were going to go to the upside, and my models just told me the opposite. And I didn't say you're stupid. My models told me the opposite. I said, you could be right, I could be wrong, which is the truth. It can happen.
Yeah.
And he kind of got really deflated over this thing happening where he was wrong on this position that he felt he was really right on. He thought he did the right analysis. And to me, all I saw was this dude who's really getting it, really trying to get it, really almost like right there, right around the corner from being a really, really good trader with the most discipline and having it all dialed. And in his head, he thought he was, at the point where he should just quit trading. So, that's
wow.
So there's two different ways to see every action that you do in trading, and really understand that those mistakes, as you said earlier, which was a great point, each mistake brings you closer to your goals. I'm not here without all my mistakes. Nobody is. There's nobody. It seems like some people, and that's the thing I think is generally as you grow up, you think like, there's these people out there that are very wealthy, or they have a great business, or they have something that you don't have, and you think like they were born and all of a sudden they were that. And if anybody knows anything about my background, that's the most opposite statement on earth. But people really, they see me sometimes and they talk to me and they think those things, even because that's just how you're conditioned. But, the thing at the end of the day is anybody in trading has had very bad things happen to them. That's the only way you become like me and have these systems and risk management, is because I have done the wrong thing to make sure I am inside my lane all the time by using these systems and my risk management.
And I think that's a really important point. I mean, just going back to, trial by error, learning by kind of throwing yourself into the fire. And it, like you said, you don't have to put on a big position, but you do need to be in the trade. And I couldn't agree more. And I want to talk about this because, I get questions a lot like, should I paper trade this and that? And I say, you can, but it's not really the same because your capital is not at risk. So you could do it to get, familiar with the personality of the instrument, but you can't really do it to get familiar with your own personality, because your money is not at risk. And so you're going to make different decisions than you would if it was. And there's very few people that I know that, and usually they're much more, kind of biased or unbiased, I should say, going into it, that do well paper trading and can convert that immediately into capital when they're trading, and they're trading their actual own money. So, using small position sizes, and then if you're really, if you want to kind of get above the statistical norm for traders, do what no one else does. I mean, so few people back test their strategies. They just think they're right, or they think they can just wing it. And, Jason, you're one of the few people I've met who thoroughly back tests and has strategies that, you have some confidence in the probabilistic outcomes that are at work. And like you said, if you're wrong, you're wrong, but you back tested this. So, probabilities are on your side. If there aren't, you can take a 1% loss in the portfolio. Either way, you survive to the next trade. And that's the other really important part about trading, is really having that sort of objectivity. You have a system, you've quantified what your risk is, you understand what the probabilities are. If it doesn't work out, it's fine, you move on. And I think that behooves us to talk about another really important part of this whole process, and that is time. As traders, we're following price and time. And one of the things you can't do is get time back. So if you're sitting there in a losing position and you're losing capital and you're losing time and the opportunity cost you're paying, you're not going to get either of those things back necessarily. Maybe you'll get lucky, maybe it bounces back, but if it's violated your thesis, if it's violated your system, if you're just holding on to it as a factor of hope, that's never a good strategy. Hope is not an investment strategy. It's even less of a trading strategy. And so it's important to cut those losses. And you can be wrong, you just don't want to stay wrong. There's nothing wrong with being wrong. It's about recognizing it early, cutting that loss so you can move on to your next trade and make it back, because that's what we do, right? If we're wrong, it's like, okay, well, we're wrong. That's unfortunate. Next. When I'm wrong on a trade, I journal it, and you've helped me to get more into this, and other folks have encouraged me the same way. I just say, hey, that didn't work out. Here's why it didn't work out. Here's what I'm going to try to do next time. And then I review all those trades where I've had good trades, neutral trades where I'm kind of flat, and trades where I'm right. And I try to go through the ones that are wrong first, because I want to look at my weaknesses. How did I mess that up? How can I make sure that next time I don't make the same mistake? Was it emotion? Was it an error in the system? Was it bad execution? What kind of happened that led me down that path? And then on the good trades, I like to review them and find patterns of what works, so I can build on that iteratively to find more of those same kind of trades. And I think that it's really important to our discipline as traders to do that, not only because we have a record, but because once we put pen to paper, or once we type it out, it also helps to ingrain memory even further. You get more familiar with your own history. You have more kind of neurosynaptic transactions happening in the brain that allow you to focus on these things more. It really is important to have that kind of muscle memory that you build, and it happens by having a really good level of cognizance of what you're doing. And then as you start trading and having your system work, and it's working better and better over time, the other thing that you find is that what works starts to form their own neural pathways. You actually become faster at making a decision. You can read a chart faster. You can read a balance sheet faster. You can make a decision looking at order flow faster. All those things start to improve, because as your brain learns new skills, it wants to optimize to spend the least amount of time. It wants to be efficient with its resources. So it forms new neural pathways to improve the time to get these things done. So the other thing that I notice a lot of the time with newer traders, they get really discouraged because they're like, I can't move like this guy. He's so fast. Like, you might, someone's sitting next to a trader, or they're watching him on a stream or whatever. And it's like, look, don't get discouraged. It's like watching, like you said, a professional athlete, or someone who's a really good video gamer, or someone else that's like a craftsman. You watch them at work and you're like, boy, I could never do that. But then if you practice and you're patient and you give yourself the time to realize, I'm not a pro, I need to get there. That's another really important thing, because a lot of people just want to front run the whole process. They think they can just, throw it all on green, and all of a sudden money's going to rain down from the sky. And you could do that in 2020. You could put money on anything. It pretty much went up. We're not in that regime anymore. And that's not a bad thing. In fact, from a market health perspective, it's a good thing. Because if we just had a market that kept climbing higher and higher and everything was going up, it's a market that's heading towards calamity when these things are so disconnected from reality, like we saw in February of 2021. Now we're in a market that's actually starting to price risk with a little bit more emphasis on the risk rather than the reward across the board. And I think that's really important, because like you were talking about earlier, we don't see people piling into defenses. We don't see people, piling in just to low volatility. There's still a bid in large cap and mid cap high beta, particularly in the cyclical names, energy, financials, materials, industrials. That's not a market where participants are saying, let's run into the foxhole, we're all about to die. That's a market where people are saying, we're late cycle, we're going to play this, and we're going to squeeze every drop we can get out of it, and we're not worried about capital preservation. Right now, we're worried about missing the boat in some of these plays. So that's another thing, because I know a lot of people are getting real bearish out there because some of their stocks aren't performing. That's not really how the market works. And does the risk increase significantly that the Fed's talking about QT? Sure, it does. Is it today? No, there's some discounting, there's some repricing, but at the end of the day, we have a lot of signals that are still saying in some parts of the market there are pockets of opportunity that we shouldn't ignore.
Yes, absolutely. And that's the thing I think we see so much, is this ability to, my things aren't working, therefore the market sucks. And this is where it comes back to living and dying in one asset class. Like, I have a lot of friends who are gold investors, or I even have friends who have gold funds, and for me and even guys who have crypto funds. I love all these guys to death, but it's the same thing that I've talked to them all about, which is you're going to live and die with that. Like that's it.
Right.
One thing that you're going to see, and once again, their mood is all wrapped in it. If gold is doing well, they're posting their returns every day. kicking ass, doing this, I'm the best, you know, whatever it is, and I'm killing it. Check out how many new clients I had. I'm like, that's cool, man. You know, great, good for you. And then, you know, 2 days later, when it goes the other direction, you know, you just don't hear from them anymore until everything's going good. And, you know, you have to, this is why, once again, it's so important to kind of understand that you have to be able to move to all these different asset classes. Especially what we're talking about is the regime is always shifting. You know, 2017, I think 2016, 2017 almost was identical to the 2020, 21 thing. I mean, and it's part of, and it's a good thing to understand and look at it, which is called the presidential cycle. I'm sure if you Google Stock Traders Almanac presidential cycle, something like that'll come up. But just understanding that these kind of things happen over and over again. An election happens, everybody thinks it's the end of the world. Oh, guess what? It isn't. The market just rips higher. 2017 was nearly the most boring market on earth. You know, the S&P just literally climbed up every single day with the lowest volatility ever. It was almost terrible to trade, honestly. But you had this thing moving up over and over again, and that regime was reflationary at that time. Boom, the Fed starts coming in talking about raising rates, but they also did it. They didn't just do slowing down of QE, which is what they're doing now. So it's very different from 2018, where they did quantitative tightening. They started changing the balance sheet, and instead of buying things, they were selling off the balance sheet aggressively. And then they raised rates at the same time. That environment changed, and this is where a shift went into nothing but the FANG stocks. The FANG stocks were the only things that moved in 2018. So you had basically Facebook fell first. There was an earnings report that came out, and there was a crash, and all of a sudden Facebook came down really hard. And then after that, it was Google, and then not Apple. Apple was the last one. Netflix got hit bad. All of these got hit bad, and then you got into late 2018. Apple had one earnings report left, which it was kind of holding up through that, and then boom, at the end of it, Apple fell, and that was the end of that market. And so, you know, that these are things you can be looking at, which is, you know, I didn't say sell everything in the beginning of 2018 because of the Fed. I said watch for these things that can happen as a market gets very thin, as breadth gets thinner, and only a few of these large cap names are holding the market up. That's a very bad regime to be in. Financials were falling off a cliff, literally. Like if you look at early 2018 to mid 2018, the S&P continued to move up throughout 2018, but financials went straight down. And everything else basically went straight down too, besides tech and the S&P 500. Now, that might sound funny because you're thinking of the S&P 500 and 500 stocks, but because it's market cap weighted, these few stocks can hold up the entire market. So as those came down, it was like legs on a chair. You know, you only had one leg left, and boom, when that fell, that was the end of that market. And then we had a nasty drawdown in the end of 2018. Fast forward into 2019, we moved into this late cycle environment. So that's a real like late cycle environment, which is where you have utility stocks moving, you have consumer staple stocks moving up, you have gold doing pretty good. It actually had a really good year that year, and you have all of these things like financials and so on not really holding up that well. Cyclicals didn't look good at all. This is an environment that is the scariest environment to be in. This is the environment where if anything happens, that market can crash at any moment. We are not in that environment today. We are in a very different environment. So the environment I just described is something that you're going to want to kind of pay attention to if you are a macro trader, to understand when you want to possibly be shifting, getting out of positions, and so on. Because that's the environment where this thing will start to fall apart, and where the Fed would actually have done something that really hurt the market. As you said, right now, that's not the case.
Yeah, and it's really going to be key to kind of watch what happens. We got so much macro data this week and Fed chatter, and then we got the Fed meeting coming up in just over 2 weeks. It's going to be really interesting to see kind of what all plays out. I feel like January, the first couple weeks helped us set the tone for the year, and we've certainly got a pretty clear indication from this market that it still wants to be in this sort of expansionary phase, and some of the components of the economy that really benefit from the changes that are happening underneath the surface seem to be the parts of the market that are rallying as well as it looks ahead. So if you're in this market and you're wondering why you're not getting returns on your investments, you got to ask yourself, are you too concentrated? Are you in names that are benefiting from the sort of regime change that's been underway for some time and is accelerating here? And if not, why not? Because I think that that's one of the things that a lot of people are getting caught up on if they're newer to this, and they didn't really realize that different sectors are appropriate at different times in the market. And it's also something that's important because if you're just cutting your teeth as an investor or a trader, there's so much to learn, and we can't try to oversimplify it. Like Jason and I have been through the trenches. We've seen things that we can try to convey in our words in terms of trying to say, don't do this, don't do that. But sometimes, as we've talked about, you kind of have to experience it for yourself. You kind of have to see some of this wild stuff firsthand to even believe it's possible. And if it's not, your own capital at risk, or if you're not at least seeing it, on your terminal kind of playing out, either in real time, if it's something very intraday or over a period of days or weeks or months, you might not have that mental sort of memory of these things happen that forms into the behaviors that might change your risk management and how you kind of target different types of trades to get into. And I think one of the things that's really important is the idea of tactical opportunism. Right? Like, just because something's going up doesn't mean you have to buy it. If you don't know why it's going up and you haven't tested any kind of strategy to quantify how it might behave, and you're just kind of doing it because of fear of missing out, then what's the strategy there, right? I mean, is it just sort of hope? Because I do see a lot of folks investing and trading with the idea of hope, and not necessarily appreciating the risk that might come with that strategy. Because if that, whatever it is that you're trading, goes the other way, what's the exit plan? Is there one? And if there's not one, what do you do? Do you just panic? Do you hide under the covers? Do you let your portfolio go to zero? Do you reverse it and you go from long to short just on impulse, hoping that now you're right on this direction? I mean, you've got to have an idea how you manage these risks. And the biggest thing that I see a lot of folks struggle with is exactly this type of concept. And that's why, and Jason and I, we did an interview last year. It was really great. I suggest you go to marketsandmayhem.com and check it out if you haven't already, because I don't want to put duplicative content out there. But one thing that Jason talked about in that interview last year that really resonated with me and some of the people that listened is you really have to be very disciplined. You have to have a mindset to trade well. It's not like you just walk in, you boot up your computer, you fire up your trading software, and you can just start trading. You really need to have an understanding of how this stuff works and how you manage those positions, because a lot of people get in trouble just kind of like funding an account and just kind of winging it, and that's not how people who make it in this industry do it. The people that make it are very detail oriented. They're very objective. They're opportunistic a lot of the times, and the kinds of risks that they take on, trying to maximize reward and minimize risk. They're people that really are hungry for knowledge. They never stop learning. They want to kind of put their all into the market so that they can make first the best investment they can ever make, which is in themselves, so that then they can make better investments and trades in the market. I mean, all of this stuff comes together, and it's really what makes us better market participants for our own financial well-being. And if the goal is financial independence, the best thing that we can do as traders and investors is keep investing in ourselves, keep investing in our skill sets, and keep working on the ideas, the systems, the tools that work. Because the thing is, like, Jason could tell you how his system works, and it works for him, and it's a great system, but maybe it doesn't work for you, or maybe my system, doesn't work for you, and that's fine. because we don't all have to have the same system, but you're still going to learn things from Jason's knowledge and his experience that are very valuable, just like you might learn things from me too. Anyone who you can talk to who's more experienced or just has different experience is a value add, because what you're doing is you're trying to skip the mistakes that other people have made, but B, fast track your knowledge building so that you can get to that next level even more rapidly. I can't tell you, there's two things, right? First, when I first started off in this in like 2005, there was like nowhere to go to talk to people. Like this was all like, all this kind of knowledge that's put out there on FinTwit and other places from some of the accounts that really throw down. That was nowhere to be found. It was all behind walls of money. And that's changed now. Now we have this incredible, and I mean in terms of the generosity of people like yourself, Jason, and other people I've met, and also just the sheer breadth of knowledge that's out there on the greater internet. There's never been a better time to self-teach. If you're autodidactic or if you're just motivated, this is the best time ever to soak up knowledge like a sponge. You have so much at your fingertips. There's even great courses out there. There's great services that don't just focus on what's the next hot thing, but trying to turn you into a better trader or an investor. So like, on the one hand, yeah, it's a difficult market. On the other hand, there's never been a better time to be a trader, both in terms of the tools that you get, the price that you get them, and the people that you have access to. When I started off on all this, if I had access to all this, my journey from being a beginner to being an experienced trader would have taken a lot less time. And it would have been a lot less lessons, kind of learned on my own, and sometimes the hard way. It would have been a lot more, working with the community and benefiting from the experience of people who are more knowledgeable. So I will say that a lot of people who are cutting their teeth trading the last couple of years, you guys don't know how good you have it. Take advantage of it. Seriously, do everything you can to benefit from this, because A, it may not always be this way. And B, this is every moment that you have is a moment to kind of skill up, get better at what you're doing so that your next trade can be better than your last one, because you never want to be stagnant as a trader. You always want to be moving forward.
Great point. And I think we'll end it right there. I think that was perfectly said. The only addition I have is that people who trade today have no idea what type of charts I had to start with. You just to add that yes, that is true. You guys are very fortunate at the moment that if you're learning how to trade, and there's lots of great information. So continue to do that. Continue to follow this page and follow Mayhem's page as well. There'll be a link in the bio for that. So we'll talk to you guys later.
Thanks for having me, Jason. This was great.
Of course.